Refinancing your home loan?
It's exactly what I'm going to do.
I want you to avoid these common mistakes that could cost you thousands. Hi there. I am Ella Garfinkle, Senior Loan Officer with almost 30 years of experience and over 2,000 families served over my lifetime. I'm here to help you break down the complexities of the mortgage realm and help you avoid the common pitfalls. I'm going to focus on the major refinancing mistakes to help you make the most out of your mortgage decision. Now, I don't want you to like or subscribe if you didn't find this video helpful. So to find out if it is helpful, you'll have to watch until the very end. One of the biggest mistakes I see clients make is overlooking the closing costs and fees that a refinance carries with it. So let's talk about the closing costs. What goes into the closing costs, what those fees should be, and why it is so important to focus on those as the number one mistake most people make. So a refinance, just like any other mortgage loan, is not free. There are costs associated with getting that loan, such as your appraisal fee, origination fees, as I refer to lender fees or company fees, title and escrow fees, tax stamps, recording fees, etc., etc., etc. All those are fixed cost items that come from third parties, like an appraiser, like a title and escrow company, like a closing attorney, like the recorder's office or the county office where your documents will be recorded and made public domain after you're done with the loan. All these items add up to closing costs. Typically, you can ballpark the numbers somewhere at between $4,000 and $6,000, depending on the state, of course, and the region, because in the attorney states, those costs can be higher, because in some parts of the country, the tax stamps can add up quite a bit to the cost of refinancing. And whenever you look at the sum total of closing costs, you have to arrive at a conclusion where the benefit is worth the total cost. Now, where it does get a little more tricky is that very few people actually will focus your attention on not just closing costs, but also the cost of the rate, otherwise known as points or discount fees or discount points, depending on who you're talking to. The bottom line is still the same. It is the cost of the rate you are getting. You can get a lower rate for more money, as in more discount points, where the discount word is hella misleading in this case because you're not really getting anything at a discount. You're paying more to get a lower rate. Or you can get a slightly higher rate and pay less for it. And it's weighing that benefit cost contradiction where most people kind of glaze over. There are certain companies out there, no names, that will gladly throw rate estimates at you and never actually point out that a below market rate, let's say 6%, don't quote me, just using that as an example, will cost you 2, maybe 3 points, meaning 2 to 3% of your loan amount. So if your loan amount is 500, even numbers, simple math, is going to cost you 2 to 3% of it, meaning 10 to 15,000, versus let's say a rate of 6.5 that will only cost you 1%, meaning only 5,000. You have to weigh the benefit of the lower payment at 6 versus 6.5 versus the extra $5,000 to $10,000 in cost that rolls back into your loan. Now, let me tell you, in my book, paying buku bucks for a lower rate rarely ever pans out because the break-even periods take so much longer on the higher costs. So consider closing costs, consider what goes into them, as in not just actual line items, but points as well. And then make your decision if you're not making a mistake. The next biggest mistake I see is when somebody wants to go from a 30-year loan into a 15 or a 20 or a 25-year loan. That is not always in your best interest, even though you're basically resetting a 30-year loan all over again, and it looks like you're extending your loan term. Well, the reality is that going from a 30-year to a 15-year bumps your payment up sometimes by as much as 50% in additional money out of your pocket every month. Yes, you're shortening the term of the loan, but do you have the means to do that every month? And in the long run, is it really something you need to do? So to me, it's one of the biggest mistakes that people don't consider is opting in for another 30 year and voluntarily paying more every month when their finances allow, because life throws us lemons on a regular basis. Meaning you don't ever know if you're going to get sick or a loved one is going to get sick and your income is going to decrease for whatever reason, or a job loss may happen. When the economy tanks, guess what? People lose jobs. When people lose jobs, can they make the higher payments? So with all of that in mind, be tied into a lower payment, but make extra principal reductions voluntarily on your own terms instead of being obligated. Now listen to this word, obligated, to a much higher payment every month in order to shave years off of your repayment. Not taking advantage of your existing equity in order to consolidate debts. To me, that's another dramatic mistake. Because if you have a ton of equity, but at the same time you have a ton of debt, you're basically equity rich and cash poor every month. Is that something you want to do? So look at the bigger picture and look at your total amount of monthly outgo via your monthly payments and how much equity you have, and if you can put that in play. So my advice to you, run a budget, look at what you can pay every month, consolidate your debts, and then apply the savings to actually pay off your loan faster. And if you want to see one of my videos on multiple ways of paying your loan off faster, there you have it. You can click on it and view it, and I want to see your feedback. Now, this mistake is something I've already touched on in the very beginning of this video, is not considering the break-even point, meaning cost versus benefit, benefit versus cost. You have to be able to calculate your break-even point, meaning what are your savings from the new rate and what the closing costs are or the additional expenses that you're rolling into the loan, and why it's essential to ensure that refinance should make sense to you personally. Just because it makes sense to somebody on a TV commercial, or just because you receive something in the mail that may or may not be actually for real, do the numbers, do the math, and if you need my help to do the math, by all means, just reach out and I'll be more than happy to run through the numbers with you and offer you, honestly, a very blunt opinion whether you should or should not do a refinance. Have you calculated your break-even point? I want to see it in the comments. More importantly, I want to see if this is new information for you, because when I discuss this with my clients, I usually get a surprise response because not everybody considers it. Because when you get a barrage of offers in the mail, they don't really tell you what the cost is going to be. They just, in big, bold letters, will show you what your monthly payment could be. But the cost of that monthly payment could be atrocious. So, break-even point, anyone? From the bottom of my heart, I want you to avoid these major mistakes and be mindful of the pitfalls so you can make a well-informed refi decision for you. I want you to consider the costs. I want you to consider not possibly going to a shorter-term loan. I want you to consider the break-even before you make this big step, because really, it is a big step. It's taking out, yes, you're replacing the old loan with a new loan, but you're still taking out another loan. Refinance is not free. There's quite a bit of cost involved that rolls back into your loan. So you want to tread carefully and make sure that whatever you're doing, the benefits will actually be worth the effort. Now, don't subscribe if this video wasn't helpful. But now that you know what to avoid, was it worth it? Do tell, and I'll see you in the next one.